In this session, I would be looking at the developments in the risk appetite framework. Sometimes we also call this risk appetite framework as the operations risk management framework. So ORMF is another common name we talk about it. So what are the improvements and the developments that are happening across the different kinds of banks as far as the operations risk management framework is concerned, and also how IT infrastructure is really a value addition, or how IT infrastructure need to be synchronized to achieve a better risk management in the banks and financial institutions. So we will look out for the key elements relating to this effective risk appetite framework. What are the metrics that are associated with it, and probably how IT will enable in terms of the proper implementation of the same. So just to understand a risk appetite framework of an organization, it is it's a framework that decides the core risk strategy of the firm. When I say core risk strategy, it means probably what is the risk profile that the company should target, how much risk it has to accept, what risks it should avoid, what risks it should mitigate, what risks it should ensure. So one, and what are the kinds of risks, what are the kinds of broad risk categories, and how much risk to be targeted, like probably what is the measure of risk? Do we use value at risk as a measure? Do we use standard deviation as a measure? And if these are the measures that are used, what should be the target numbers associated with it? So keeping in view the broad business profile of the organization, this risk appetite framework is designed, which will help the senior managers in designing a core risk strategy for the improvement of their business, or probably it helps them to take calculated risk in their decision making, integrate risk management into the decision making. All these things can very comfortably be achieved using a solid risk appetite framework in the organizations. Then, if at all I am talking about developing such a kind of RAF statement, appetite framework statement, what all should be included into that statement? The first thing I look out for is the business profile. What are the kind of lines the business is operating into? What are the risks associated with each of the lines of business? Probably this is very heavy into retail loans but very less into commercial loans. Whereas some other bank could be more and more having a very big investment banking kind of operations but very less into commercial banking. So different lines of business could differentiate the risk profiles of the bank. So first understand the business profile mix of that bank and the balance sheet mix. So some key elements of the balance sheet like debt to equity ratio, right? The capital structure associated with it, the sources of funds, the way that the composition of the sources of funds, and it could also come to an extent of how much of liquid assets are there and how much of fixed assets are there. All these things, the composition of the balance sheet should be understood to a great extent. And risk preferences, what are the core risks for the bank company versus the non-core risks. Probably for a company which is manufacturing automobiles, the business related risk is always a core risk. but probably something to do with the market, something to do with the credit, they all go as a part of non-core because the company is not into the management of those things. But understanding the business, how much to produce, all those things go as a part of the core risk. So it may so happen that the company may accept the core risk, whereas it may diversify or hedge these non-core kind of risk. So we need to really understand as a part of the designing of the framework, we need to understand the risk preferences the companies have for each type of risk. When I say each type of risk, probably I'm looking at market risk, credit risk, operations risk, business risk, liquidity risk, so many such kind of risks. So I need to understand what is the priority or the preference of the company to each of those risks. Then I'm looking at the acceptable levels between the risk and return. How much risk I can bear. See, we know this statement, higher the risk means higher returns, higher expected return. But there is a high possibility of a loss also. So to what extent I can compromise between the two, right? To what extent I am ready to bear the loss, and because of that additional risk, what is that additional return that I am expecting? Even that should be present as a part of the framework. And even the volatility, it's just not the absolute amount, how much volatility I can bear, which is generally volatility is a measure of risk. So to what extent I am ready to bear this risk? What is the volatility of the returns? What is the volatility of my expected behavior? Then it should also talk about the capital threshold, preferably for each of the layers, each of the types of risk. Probably the economic, it can talk about the economic capital at a very broad layer, probably economic or regulatory kind of capital. And at each of the layer, okay, market risk, what is the charge per market risk? What is the capital that we are talking about for credit risk? What is the capital for operations risk? So the threshold, overall threshold, and each type wise limits or capital allocations, they need to be clearly defined. And if at all there are some kind of targeted credit ratings, even they have to be very clearly identified, right? Probably after a certain, within this year, my credit rating should not fall below a triple B. So to achieve that, whatever is the maximum risk that I can target, I can look out for that. So before that, I have to design what should be my targeted credit rating for that, and what are my tolerated post-stress losses, to what extent I am ready after the stress testing, whatever the losses are coming up, to what extent are they tolerable, or to what extent I have the backup to bear those losses, to what extent I am fine with those stress tested losses, because stress testing may happen in a hypothetical scenario. So to what extent I am comfortable to handle my stress tested losses, and some kind of calculations associated with the liquidity ratios. What is my targeted or optimal risk liquidity ratios? All these things should go as a part of a risk appetite framework, which will help the management as well as the various layers in the organization to take planning and decision making in a very effective manner, and it keeps them get ready for the unexpected. Even if the worst case happens, even if the worst case happens, I'm ready for it. I have the sufficient backup for it. I can address, I will not go bankrupt just because one unexpected thing has happened. That is what will be the benefit that can come with an effective risk appetite framework. So we are going to look at the broad big picture of the risk profile of the company, which will help in terms of really assessing the performance and probably improve and take efficient, effective actions for overcoming the crisis in a much better manner. So that is the reason risk appetite framework today has become more and more popular, and it really helps the firm in terms of managing the unexpected in a very effective manner. Now, as a part of this implementation process, okay, we talked about what should be the content of that risk appetite framework. Now, if I have to look at the implementation part of it, what should be really done across the various levels in the organization? So it should start right from the top in the organization, probably at a CEO level. At there should be a specially designated person called CRO, the Chief Risk Officer, who should be designated as one point contact for all risk issues. Probably he could be directly reporting to the CEO. He might be present on the board for all the performance, risk-based performance reviews and modifications and improvements to the risk management framework. So, just to give a flavor from a risk dimension to the organization, a CRO should be given a good amount of responsibility and accountability as far as the risk is concerned. So there should be a risk committee that should be formed by the board, which will typically identify the performance of the CRO and even the compensation of the CRO. It is not decided by the CEO, who might have a different set of priorities in comparison with the CRO. So right from the board, the compensation decisions come up. But yes, the good thing which should happen in any organization is the relationship between CFO and CRO, because CFO is more and more associated with the budgeting and money related issues, whereas CRO is more and more related with the risk management kind of aspects. So the more and more interaction that exists between these two groups or these two set of people will build an effective risk culture in the organization. So all the financial related impacts, right? When one good risk management practice is implemented in the organization, what is the cost saving that the company has got, or what is the loss reduction the company has got, the numbers would be present directly with the CFO, and he can present those financial impacts. So right at the cost level, okay, to implement one good risk management practice, what is the additional cost that is involved, even that would be presented by the CFO. And of course, because of the implementation of this risk management practice, what is the effective improvement overall on a regular basis is also very clearly, cleverly known to the CFO. So the good relationship between these two parties will definitely promote a very healthy risk management culture within the organization. And always on a regular basis, on a periodic meetings, it is always better to compare the firm's existing risk profile with that of the framework, and probably if required keep modifying the framework or probably keep improving the framework to reflect the realities that are coming on a periodic basis. Whereas coming to the CEO, he should make sure that he is using the framework for all the strategic decisions. That itself will create a confidence among the senior management as well as the employees down the framework, that this framework is what senior management is buying. It is not just another framework that is existing in documentations. It is something that the organization is really believing and moving forward. So that is one thing. The risk appetite framework should really be implemented by CEO for all the decision making purposes. Here the another important aspect that comes is more and more freedom given to CRO, more and more accountability, more and more responsibility given to the CRO will definitely strengthen the risk management practice in the organization. And on a regular basis, any kind of non-compliance or violations with respect to risk appetite framework, it should be considered seriously both by the CEO and the CRO, and really action plans have to be implemented on the same, and that's how a continuous ongoing improvement process will definitely come up and the culture really develops within the organization. And when it comes to the board, it is a clear responsibility to the board that the entire risk appetite framework gets into the genes of the entire organization. So communicating the framework across all the layers of the organization and getting a buying from all employees is what is the responsibility of the board. And so that means the board has to be more and more forward looking rather than trying to brood over the past issues. And of course, the historical things will definitely be learnings for the future, but more and more forward outlook is what is expected by the board of directors. And even that will help them to set proper expectations for the management for the next financial year, probably saying the compensation may not be directly linked to profits, but compensation may be linked to more and more effective risk management. So these kind of things, expectations setting to the management and all, become quite effective if the board takes that kind of a responsibility. But the good thing is, but the required thing is, the board should be fully knowledgeable in the areas. At least few key members of the board, they should have the relevant knowledge and relevant work experience with respect to the risk management. Otherwise it becomes a top priority that they need to be fully trained on those things so that they can take better decisions with respect to risk management. And whatever the reporting that comes from the management with respect to the, as far as the risk practices are concerned, it should be more and more comprehensive and just not at a very high level. It should be a detailed kind of stuff from an overall business perspective. What are the kind of impacts of various risks that are affecting the business, and even management of the reputation risk. Sometimes some people file a lawsuit against a company for some reason, so making sure that the reputation risk management also comes in process. Some of the key things which are identified as best practices at the various levels in the organization. Then, okay, at a broad level, fair enough. Now what about the individual managers level? That is what we'll see. How does the framework handle the individual business line level risk? Now every project, right? Now when we are talking about an enterprise wide risk appetite framework, now every project will design its own risks. Now what we are saying is, if there is such kind of a framework, all these project managers will try to align their risks with respect to the firm's overall desired risk level. So that will help them, even from a senior management perspective, that will make each of these business line managers take the responsibility of submitting their business plans, probably long term, medium term business plans, and they can really check for the consistency of this plan with the overall risk appetite framework. So some kind of stress tests on the same can be done. To each business line, some kind of capital that is allocated and risk limit that is allocated. These all can be really done once this framework is quite effective. And even at a very low level in the organization, line managers, they can suggest improvement in the plan and contribute to the overall benefit of the organization. So if all of them are integrated into a comprehensive implementation mechanism, obviously the overall risk can very well come down, because here at this level there could be some good diversification benefits. All these things can act together, which will help in the reduction of overall risk of the firm, leading to increased profitability of the firm. And sometimes when the economy is not doing well, and various pathetic situations come out, people can understand and appreciate the overall big picture of the organization, which can result in drift of the risk appetite completely, and it can really cause a benefit to the organization itself. Uh, so even at lower levels, even at a middle management layer, if this risk appetite framework is imbibed into them, so that is what is the responsibility of the board. Make sure that the employees at various levels in the organization really understand this culture, really imbibe this culture, and really get charged up to implement this kind of a framework across all layers in the organization. Then we are also talking about what kind of metrics should be looked at a part of the effective risk appetite framework. Let's say if I'm implementing, now coming to the implementation part of it, and that too the measurement aspects relating to the implementation. Let's say I'm targeting the implementation of effective risk appetite framework. What are the various metrics or measures that I need to consider? It starts, so these kind of things need to be monitored at a regular intervals, probably on a periodic basis. The capital targets need to be monitored. It could start right from the economic capital. Am I continuously meeting my economic capital requirements? Or probably I can look at the capital structure. What is the debt to equity ratio on a regular basis? So all these kind are probably some kind of risk measures. Like if required, I need to look out for the value at risk or expected shortfall. Any kind of a risk measure that I am defining, I need to really compute that. I need to really report the same. I need to really evaluate and assess the same on a constant basis. Then some kind of liquidity ratios, probably short-term liquidity ratio, long-term liquidity ratios, different kinds of liquidity ratios need to be looked at and compared across the periods. And to what extent the net income is volatile, what is the consistency with respect to the net income, and what is the, how is there any way I can compute earnings at risk, just like the way we are talking about value at risk. So that is nothing but based on the volatility that is associated with the net interest income for each of the periods. Similarly, I can compute the value at risk and sensitivities associated with that, perform a sensitivity analysis and communicate the same. Expected loss ratio can be computed and communicated. The credit spread, what is the change in the credit spread, or probably the ratings that are assigned, when is the change in the ratings of my own ratings as well as the ratings of my borrowers at various points in time. What are the changes into the credit ratings associated, which are again determined based on the credit spread itself. And what is the range of asset growth? Is it growing organically, or is there a drastic growth because of mergers and acquisitions? Or probably look at each business line, right? Probably in the retail segment, what is the business growth, what is the assets growth, or probably in the commercial loans, what is the assets growth, or in some investments related thing, what is the assets growth. Try to look out on the various asset growth across the various risk types as well as business types, and also try to identify whether in any of those types some kind of ceilings have been crossed or not. Then also look out for the economic value addition. right? We know the economic value addition is nothing but the residual income, which can be computed as net income minus the charge. So cost of equity times the equity capital. So is there a positive economic value add, or is there a negative one? And post stress, after the stress testing, what should be your targeted outcomes, and is there any deviation from those kind of things? So there could be a lot of details, a lot of calculations, a lot of metrics that can be considered and can be evaluated as a part of the effective risk appetite framework. So for doing all this, of course, one, we need very good risk data. Two, we need good infrastructure, because a good infrastructure will help me first capture different types of risks. So any small risk occurred in any department, if it is recorded, probably I can aggregate them very much better, and I can save a lot of time on that, which will, and probably with effective infrastructure and systems in place, the decision making becomes more and more easy on time, because most of the time the decisions have to be on time. Probably whatever the analysis I have, whatever the data I have captured, let's say in the last 1 month, if I am doing the analysis, if my analysis is taking 1 month, probably only for the next month, if I am able to get the analysis out of it, in this 1 month something else would have changed drastically. So the more quicker, the more timely the analysis I get, the more effective it is. So that is where the infrastructure, IT play a very key role in the implementation of risk management or risk frameworks. So so we have to really decide for each of the reporting activities, or whatever calculations that need to be computed and then reported. We need to identify the list of all the metrics, the time frames at which I have to report them, and I have to design my IT infrastructure systems in line with that kind of objectives. So when we are talking about effective IT risk management policy in the organization, so because IT forms one of the key backbones of the risk management aspect, or even today, every company is using IT as an aid for growing business. So it could go from right from a very simple website for communication of the details to a lot of online transactions, to a lot of social media kind of stuff. So today lots and lots of IT related applications are being used by banks, financial institutions, and for that matter any kind of companies for the growth of their business. So it is very much necessary for us to understand the IT risk management aspects, right? So what is suggested is the standards need to be very clearly developed, and reporting also on a regular basis, the internal risk reporting, the frequency, the metrics, what will be reported, to whom they all will be reported, what to do with the violations, all that framework, the internal risk related things have to be very clearly documented. How much of funding? See, sometimes what happens is a kind of friction between the line managers and IT managers becomes a very big blockade in the organization, because line managers are more or less responsible for immediate profitability of the business, whereas IT is typically viewed as a support organization in all these support function in all these organizations. So the funding for the development of the IT systems becomes a serious issue. So that is where we have to make sure that as a part of the risk management policy itself, there should be a clear documentation associated with the funds that would be allotted for the development of the internal risk management system, and the IT infrastructure, whatever is getting assigned, we should make sure that it is approved properly, and probably any new line level products that are being introduced by the company, they should be really verified by the IT companies, IT function head also, because we should really know whether the IT infrastructure which the firm currently has can support that new line level products that are being introduced into the organization. So every new product, every new activity that is being introduced, it should be ensured that proper approvals even from the IT department come up for the same. And every model that is being implemented, every framework that is being implemented, there should be a post implementation review also, so to ensure that no IT related issue is coming up with respect to the risk management activity, with respect to the risk management application that is built, no IT related issue is coming out. And especially when you have outsourced various activities. So IT outsourcing today is a very common activity. Probably in India, majority of the companies are doing the outsourcing work for major financial majors in US. So whenever a financial major in US is outsourcing an IT activity to a company in India or in China, the proper governance has to be looked at into those things, because it has to be treated on the similar lines as the governance they do for their own in-house development application. So it should not be in line with the outsourcing company's guidelines, but the outsourced company, or also the company which has given the outsourcing, it has to make sure that even its subcontractor is following the risk management framework in a similar way that the parent company is or that the outsourcing company is really following. Then the project management office has to be very effective. They should define proper timelines. They should define proper milestones, right? The typical project management words like milestones, deadlines, they all need to be properly defined and needs to be communicated to the team, and it has to be tracked properly. Probably they can use some kind of softwares to do the tracking of the entire project management activity. Whatever it is, they should have proper processes in place for, and there should be a few dedicated people, probably one point contact as the head of the particular project, or that would really ensure that the responsibility is taken for completing it on time, finishing it within the budget. All these things come up, and even there should be a mechanism. There should be a data administrator as well as data owner, because this entire frameworks, building the tools and all, is purely based on the accuracy and the integrity of the data. So we use a role called data owner, whose responsibility is to ensure the same. And on a regular basis, we talk about internal audits for product, business, purely from an IT usage perspective. So that's how a company has to develop a very good IT risk management policy, which will help them in improving the regular operations risk also, because one of the key areas of operations risk is systems based. So ensuring that the risk relating to this is more or less taken care of to a large extent ensures a better implementation of the risk management framework in the organization. So in case we are not able to implement a better infrastructure, IT infrastructure, a few things which can really have contributed to the poor infrastructure in the organization is there should be a synchronization between the IT management and the business line. Generally, we see they are as process. As I have already mentioned, the business line managers target the profitability immediately, whereas the IT management is viewed as a support function in the organization. So generally we find that the understanding levels are not common between the two. So there will always be a fight for funds. Right, the line managers may not agree for giving more funds to the IT department because it is viewed as a support department. So for the fund allocations and all these aspects, we see a serious level fight between the IT management and the business lines. So that is something that needs to be aligned. If at all across the organization, this culture has to develop. Then the management generally makes the decisions on the short-term profits. So when the priority comes for short-term profit, the support department, which is the IT, always takes a backseat. So most of the IT infrastructure based projects, they are put on hold, they are delayed. So typically on a long term, this will impact the operational efficiency of the company. Then the key people who are in IT. What is observed is over the last few years, there has been a lot of turnover. They have wide variety of opportunities across wide variety of businesses. So it is seen that the employee turnover in IT related roles is very high compared to the other roles, which has resulted in delay in many IT projects. So even that needs to be taken into consideration by the organization. And the governance activities, the data management activities, there is a lot of area of improvement for them. There is a lot of inconsistency across the various business lines in terms of how they are capturing the data, how they are managing the data, how they are reporting the data, what are the governance issues related to the data. There is a high level of insufficiency and inconsistency across the various business lines, which is what is creating problems with respect to the creation of the models or using the IT infrastructure for the effective purposes. And especially when there are M&A kind of activities where different organizations, let's say X has acquired Y. X is having one kind of risk management system, Y is having other kind of risk management system. Probably this is more of based on open source technology, whereas this might be based more on proprietary technologies. So integrating these two things is a very serious problem for the organizations. So the data aggregation and then assessment, because of the issues relating to the IT tools and softwares and these kind of aspects, we see some level of inconsistency even at that dimension. So even those things have to be targeted for a better implementation of the risk management framework within the organization. And one more dimension that is looked at is with respect to the data aggregation itself, especially multiple systems. Today we see any big company for various activities, okay, for reporting, they use some software. For statistical analysis, they use some other software. Probably for regular day-to-day operations management, they use another software. For lending decisions, credit decisions, they may use another software. Now integration across all these things is a very serious problem. So that is where there should be a lot of focus, especially multiple softwares purchased, multiple tools purchased to address multiple business issues, and the lack of integratability across all these softwares is one of the serious problems that is driving the risk, that is making the risk management more and more ineffective as far as the operations is concerned. Then automation, to a large extent, if I am able to automate it, it will limit the intervention and the manipulation processes. To some extent, let's say if I am using Excel spreadsheet for document for capturing all the risks, and I can very well make sure that it can only be entered and it cannot be modified or tampered or any of those things. So the more and more I put in protection related stuff, the more and more I put in the manipulation prevention kind of stuff, it increases the accuracy and betterment of the data. So some such kind of automated kind of things have to be taken care of. And any risk report that is coming up, we should set clear deadlines, we should set clear formats, clear standards, probably come out with very interactive dashboards for the same, to ensure that the internal risk reports are proper and containing the appropriate information with respect to the big picture. And make sure that we use centralized databases for capturing all the data rather than all discrete databases containing different data at different places, which will not only increase the effort in terms of aggregating, but also will create lots of errors with respect to aggregating. So this kind of complex structure can be removed. Probably the more and more the centralization in the database is happening. Along with that, it is suggested that there is a data warehouse. Any number of subsystems, X1, X2, X3, X4, if you have for different purposes, you make sure that the output of all of them is getting aggregated into a warehouse, which can really use that information to provide some kind of dynamic interactive reports based on the queries that are typically posed to the system. And make sure to whatever extent possible the reconciliation that happens at various layers, it is automated and on a periodic basis, which will try to eliminate the manual errors to a large extent. And especially when there are legacy IT systems for long old data, probably the companies may be using some kind of mainframe based systems or AS400 based systems, wherein large volumes of data has been lying, because probably the data has been lying in the systems right from 60s and 70s, where the current sophisticated databases may not be available. So especially when companies are trying to integrate those kind of legacy IT systems because of M&A deals and all, proper care and proper practices have to be set in place to make sure that the integration happens quite smoothly, the aggregated data is correct and accurate in all aspects, and any new software that is planned to be bought, it should be ensured that that particular new software is compatible with the existing ones. Otherwise, there is going to be a huge amount of rework which will cause additional risk to the teams, and as well as it increases the overall risk level of the organization. So these are some of the things that we are looking at in this session for the developments in the risk appetite framework, as well as understanding of the IT infrastructure, which forms some of the key for operational risk management practice in the organization. If you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.